Morning. We're going to get started in about a minute or so. We got a few last people joining the webinar today. Great. I'm going to go ahead and get started today. My name's Erik Daley. I am a consultant with Multnomah Group. I'm joined today by Treichel, who's also a consultant and the director of our technical services at Multnomah Group. Today's webinar is a recap of 2016 to help you develop kind of your strategic plan as it relates to your retirement plans for 2017. A few housekeeping things before I jump in to the agenda. We are recording today's presentation, so to the extent that you or your colleagues have a wish to review some of today's content at a later date, that should be available usually within 48 to 72 hours after the conclusion on our website, and for those who can't make it, we'll distribute a copy as well. Second note that we have the lines muted just to maintain the audio quality. So you are welcome to submit questions. I'd encourage you to do that through the Q&A window through the GoToWebinar app, and we'll address those as well. And then last but not least, a copy of today's PowerPoint presentation will also be distributed to those who attended today. So don't feel like you have to madly scribble down everything on the pages today. We'll send the pages to you again sometime likely early next week. As we get into the presentation, there's really 5 things that Bonnie and I highlighted as being kind of top events that we think will bleed from 2016 into 2017. Certainly the one that is arguably sucking the oxygen out of most rooms is the impact of the presidential election and what that will mean from a market policy perspective. We're also going to take a look at what has continued to be a significant proliferation of class action litigation and where that may lead us to next. One of the big regulatory changes for 2016 that arguably got lost in the wash of other political news had to do with changes to money markets and how money market investment products are both categorized and the impact of that categorization on their performance and liquidity. We'll talk about that and how it'll impact 2017. We're going to talk about the continuing reduction and demise and end of revenue sharing as a primary method for plan economics, certainly in the defined contribution space. So we'll work through where we think that is going. And last but not least is the DOL fiduciary rule, so slated for April of 2017, but in a lot of ways impacted by some of the other things that we're talking about today. And then we're going to talk at the end about how those 5 big changes for 2016 are likely to impact your work plan for 2017. And then obviously we'll open it up for some questions. So I'm going to start on the presidential election. I'll take half the topic, and Bonnie will take the other part. I think it's a material enough change that it certainly impacts retirement plans much more significantly than I think many might think initially. Let me talk about where we were in September 30th, October 31st, even up and through the middle of November. There was a lot of very positive economic news coming out. The first that real GDP grew at 3.5% quarter over quarter, which was a huge number for the economy, and was up 1.7% year over year if you look at Q3 2016 through September 30th. Core consumer inflation, which strips out, food and energy, was actually down 2.1%. So we haven't seen a material impact in prices. The number of Americans filing unemployment remained tremendously low, and we're beginning to see some not insignificant pressure on wages, which has been a big complaint of the recovery, is that wages have been relatively stagnant, with some notable exceptions for specific segments of the marketplace. The trade deficit continues to widen. In November of 2016, it was up to $65.3 billion as the dollar strengthened and imports continued to outpace exports significantly. And consumer confidence in December hit its highest level in over 15 years. All of those things are certainly very, very positive from an economic perspective. The yield, however, on the 10-year Treasury went from 160 to 245, so more than a 50% increase in yield over the course of 2016 as a result of two factors, really. One, the first being changes in the overall market sentiment, which were positive and certainly tends to fuel higher rates, and most notably the Fed increasing rates for the first time in what's been really a decade. They've raised rates twice, and this is the second of those two rate increases. So then we had an election, and a couple of things happened. We broke out returns for the S&P 500 index as well as the Barclays aggregate bond really from the date after the election through yesterday. And what's certainly notable about the S&P is it's up a little over 7% in the very, very short period of time between November the 9th and January the 24th. What's also notable is the opposite impact on the Barclays Aggregate Bond Index. So again, as a result of those rate increases and actions by the Fed and a strengthening economy, we've actually seen bond returns down about 2% in a very, very short period of time. And if we were to break that into really two different phenomena occurring, if you want to look at things that are likely to have a positive impact on stock performance, so certainly the president's policies are perceived to be favoring economic growth and corporate profits. A big piece of that is a proposed reduction in corporate taxes, which would generate presumably greater profits. There's been a talk of a $1 trillion domestic infrastructure plan. There's been significant talk about the reduction in regulation. So if you want to look at sectors of the economy that have done extraordinarily well in the very, very short period of time from November 9th, it's certainly on the banking side. So reduced regulation, the potential to eliminate the Dodd-Frank Act, for instance, would have presumably a positive impact on corporate profits. It's important to point out that markets react to profits, not necessarily overall economic impact. So whether you're favoring or not favoring the president's economic proposals is not necessarily going to show up in stock market returns. So if you're not in favor of those policies on an economic perspective, the stock market and the economy are very, very different instruments. Although they get conflated regularly, they clearly are very, very different. But those particular positive impacts on performance are showing up very, very quickly in markets. There are a couple of things that would be a counterbalance to that from a stock market perspective. So already the president's opted out of the TPP, the Trans-Pacific Partnership Asian Trade Pact. They've begun a process to try and renegotiate NAFTA, which is the North American Free Trade Act. Those should have a pretty negative impact on domestic exporters. So if you're exporting either to Asia or within the Americas, it is likely that the uncertainty related to those trade policies would be negatively impacting your business. The second is that the more restrictive policing of undocumented aliens certainly may increase labor costs. There's been a lot of talk, especially in the last 2 or 3 days, about changing labor practices and measurements. That could certainly inflate labor costs. Inflating labor costs would likely show up in higher prices and potentially lower profits for domestic producers. The other more uncertain impact, I think, certainly is internationally, and I do think that our elections impact international markets. I think we've seen that already. The higher interest rates associated with greater growth expectations here have and could presumably for some time continue to negatively impact bond rates. So as yields increase, bond performance would be on the negative side of that. And the other thing we've seen is the significant difference in performance of domestic stocks versus international. A big piece of that is that with higher interest rates, presumed greater growth, and a strengthening U.S. economy, that would push the dollar higher versus other currencies. If you want to look at the peso, for instance, as being a measure, the peso's performance post-election has been dramatically negative in impacting performance. But here's the returns for most of the market segments from November the 9th through January the 24th. Really everything up with the exception of aggregate bonds down 2%. And as I mentioned earlier, the places where we've seen the greatest performance really on the value side of the spectrum. So the value side is largely driven by energy prices and secondarily by financial service markets. Both of those have performed very, very well in anticipation of potential changes to the regulatory environment. So with that, I'm going to throw it over to Bonnie to talk a little bit about the regulatory impact of the election and how that may play out.
Great, thanks, Erik. So, before I jump into talking about the regulatory impact, and really I'm going to spend most of my time talking about some of the appointments that have been proposed by President Trump, I want to make a couple of key points just to keep in mind. So one of those is that, I'm not a Washington insider, and this information changes really quickly, as quickly as President Trump can tweet that out in the middle of the night. So, one thing to keep in mind is that, from the plan sponsor perspective, you have to really keep up on this from a day-to-day perspective. So keep in mind that some of this information changes very quickly. The second point I want to make is that these appointments that I'm going to chat about briefly, they really do matter. So these appointed positions, they're very critical as these leaders really do have the opportunity to shape policy, and then they'll engage in subsequent hiring for key staff to aid in how this policy will actually be carried out, not only just in Washington, but really back in our home states. So we just want to keep that in mind, that that's really why having a conversation about these appointments under President Trump, why that's an important dialogue to have. So with that being said, today I'm going to talk about two appointments that I think are critical for the financial services and the retirement plan industry. And the first one is going to be the SEC appointment, which I think that gets a little bit less attention than the second one that we'll talk about, which is the DOL appointment. So that first appointed position is the SEC chairman nominee, Jay Clayton. So you want to keep in mind what the role of the SEC or the Securities and Exchange Commission, what that person does. So the head of the SEC, they'll set the agenda, that agenda for the actual SEC. They'll hire staff, they'll run the day-to-day operations, or rather be in charge of that. They'll represent the SEC. They'll be that spokesperson to Congress. And then also kind of keep in mind what the SEC, how their structure is. So typically the SEC, they have the chairperson and then there's 4 commissioners. Right now, 2 of those commissioner positions are actually open positions. So right now the SEC is just running with 2 people really, because as of the 20th of January, the current head of the SEC, Mary Jo White, she departed, and then at that time there were 2 positions open. So we've just got 2 people really manning the ship there for the SEC. So, a little bit about Jay Clayton, the current nominee. His background, it would suggest that he's going to be a little bit more focused on helping with really helping with raising capital for financial services firms. He's probably going to be a little bit less inclined or less focused on tightening of regulation. He has a background really in helping with M&A. He's a transactional attorney by background. So I think that suggests, both from my perspective and probably some of the trade press that you've been reading, that he's going to be more focused on helping with the building of financial services firms and helping them with raising capital, and a little bit as to what Erik was just suggesting as well. So with respect to when will that nomination actually be confirmed, historically the confirmation of SEC appointments has really been a low priority. However, that potentially could be fast-tracked a little bit. I don't believe a date has been set, but given that there's only 2 people currently at the SEC, potentially that'll get fast-tracked a little bit more. The other position that we wanted to talk a little bit about is the DOL Secretary nomination, Andrew Pudzer. And that's another really key appointment, I think, for those of you on the line, because there's really, I think, 2 big questions that you probably are keeping in mind, which is, number one, how would this nominee impact ACA? And then number 2, how would this nomination impact the Department of Labor's fiduciary rule that we've talked a lot about over the past year? So a lot of you are probably familiar with this nominee because of his work as the CEO for Hardee's or Carl's Jr. So most of his career was spent being more vocal on things like job growth, wage concerns, opposing ACA, and to my knowledge, I am pretty sure he's been silent on the Department of Labor's fiduciary rule entirely. But obviously, he's very pro-business. Again, going back to that notion of emphasis on less regulation, promotion of growth for businesses, and with respect to his actual confirmation date, originally that was scheduled in January, and that's now been pushed to February 2nd, so just coming around the corner next week. So briefly, I just want to mention, I don't want to get into the weeds on this, but I'll mention the likelihood of these appointments being confirmed or not. So, so far we know that the appointments that President Trump has put forward, they've all been confirmed. While there is some media attention around the pushback for some of these appointments, I'd say that the likelihood of the appointments actually getting blocked is probably fairly slim, given the majority that the Republicans hold in Congress. So I would say, what this is all leading toward is really what that 3rd bullet point talks about, which is, deregulation. You're getting the theme here with these nominations of deregulation or scale back of existing regulations for these financial services firms and the banking industry. So really, what does that mean for a plan sponsor? I think it means that there's going to be obviously less regulation and enforcement around the rules and regulations for financial services firms that are servicing your retirement plans, and potentially, some of the regulations that apply to running your retirement plan. So, for example, Erik mentioned a few minutes ago Dodd-Frank. I think that's likely on the chopping block to be substantially revised or pulled back, along obviously with ACA and then the DOL's fiduciary rule. So we'll discuss the DOL fiduciary rule a little bit more and a little later in the presentation. But for some of these regulations that are already in the pipeline, I think it's tough for them to be pulled back entirely, particularly given the amount of money and time and marketing efforts that have been spent around some of these regulations. However, I'd also submit that I think here at Multnomah Group, we oftentimes think that, litigation in the plaintiff's bar, they'll often step in and fill the gap to replace when regulatory oversight is pulled back. So I think that'll probably make a perfect segue into our next topic, which is talking a little bit more about what we saw with respect to litigation targets and theories and trends in 2016, and then how that will take us into 2017. So over the past year, I think, we saw a few new trends with litigation, and we also saw a continued uptick in litigation. So first, I think for a lot of our clients who are on the line, one of the things that's the most compelling is that we saw colleges and universities became a target really for the first time in the ERISA litigation field. So in August, we saw that we had really a big kind of onslaught of cases that were filed against 12 colleges and universities. So historically, 403Bs were not a target to the major class action litigation lawsuits. However, Schlichter-Bogart out of St. Louis filed, I would say, fairly substantially similar lawsuits against 12 colleges and universities, and that was back in August 2016. So, you know, the allegations are obviously a little bit different across those cases, but there's several similar allegations, which include things like, you know, too many record keepers, which results in higher fees for participants. Also, the argument that there's too many investment options and that creates confusion for participants, and that there's duplicative investment options. Another argument in those cases is that there's revenue sharing, and that leads to excessive fees and to kickbacks. There's also these arguments that they used actively managed rather than passively managed funds. Also, sometimes that, you know, there's a retail share class that was used when instead an institutional share class was available. And also the argument that there's, you know, the lack of a competitive request for proposal process that was used to find the record keeper. So those were the types of arguments that were made against these 12 colleges and universities. Now, to date, where do those cases stand? I believe that nearly all of the universities have filed motions to dismiss. It was interesting to read some of those motions because some of them had some fairly novel arguments. Some of them were just pretty straightforward arguments, and now they're really just in that motion process, or, you know, going back and forth, and we're waiting to see if any of those motions to dismiss will be granted. You know, what's difficult is that there's not always a lot of case law, because a lot of times when the cases were historically filed against these Fortune 500 companies, historically against cases, the Kraft, Boeing, et cetera, there was always a settlement. And so now I guess we just wait to see if any of these cases will settle, or if, you know, the universities will be more inclined to take it all the way so that we'll actually have some case law. So stay tuned to see what will happen in the 12 college and university cases. Another one of the targets that we saw kind of for the first time this year was a down market movement in the ERISA litigation towards small plan sponsors. So there were two cases that we had done some blog posts on earlier this year, and one of them actually became really interesting. The first one that I'll mention is a case against CheckSmart, and that was a case that was filed against CheckSmart, and it was plan assets at issue of about $25 million. So I think, you know, historically what that shows is that instead of just always being against the bigger plans, it was starting to move down market and be against smaller plans. The second case that I'll mention is a case that was filed, and it was a case where there was only about $9.2 million in total plan assets at issue. At first, this really kind of set off alarms that, oh wow, litigation's really moving down market. Interestingly enough, that case actually eventually was voluntarily withdrawn. And so I think that really shows that, you know, two things. Number one, there's starting to be a lot of what I'll call copycat lawsuits, because you can easily have attorneys basically copy and paste and duplicate these lawsuits against that came from the bigger plans and then duplicate them against smaller plans. But number two, what it shows is that you really, if you have your fiduciary file in good order and you can easily defend against these suits, then they can get dismissed. And in that case, they didn't even have to go through all the motion practice. I think they had some easily available and readily available facts from their fiduciary file in good order, and that case was voluntarily thrown out. So, you know, in total there, I think it just shows, I don't want to belabor the points, but that the targets of litigation are changing, and they're also expanding, and it's not just confined to the mega 401k plans. In addition, the theories of litigation are also changing. So traditionally on the retirement side, litigation was primarily focused on just, you know, stock drop cases and excessive fees. However, I would expect to see continued expansion in the theories and attacks on plan sponsors as well as on service providers. So I'll just briefly mention, you know, first, I would expect to see more cases like the Bell versus Anthem, where there's an attack for fund selection and choosing, for example, you know, the Vanguard fund that was 4 basis points rather than the one that was 2 basis points. You know, likewise, there's been other cases where the argument was made that, you know, for stable value as opposed to the money market fund. So I think we'll continue to see more cases like that. And then second, there was a flood of cases against providers. And so these were cases against financial institutions who were also the plan sponsor. So the plaintiffs, again, here, they're making similar claims as in the traditional excessive fee cases, but then they're also alleging that the plan sponsor, who's also a financial institution, used affiliated investment products and service providers to increase the financial institution's revenue. So these self-interested actions, the plaintiffs claim, they're saying they're breaches of fiduciary duty, and then they're also prohibited transactions. So this started in 2016, and I think we'll see that continue into 2017. So two other things I want to briefly mention before we move out of litigation and then on to money market. Briefly, I'll just touch on Tibble, which I think we finally really saw kind of wrap up in 2016. And what does that mean for you? I think what it means for you in 2017 is that we'll see we'll see kind of that play out in 2017 with what does the duty to monitor actually mean. I think we'll see that litigated more in 2017. So you can expect to see in terms of, how much do you have to monitor, like what's the depth of that, and what's the frequency of monitoring activities. I think you can expect to see some of that in litigation to come in 2017. And then finally, church plans. If this applies to, I know this is a pretty limited group that this applies to, but we saw this bubbling up in 16, and I think you'll see in 17, the Supreme Court made the decision to grant cert with respect to the definition of church plans under ERISA and the Internal Revenue Code, and I think that can also produce a large amount of litigation against church-affiliated organizations. So with that being said, I know that's a lot on the litigation front, but I'm going to toss it back to Erik to talk about changes to money market.
Thanks, Bonnie. And it is a good feed. I mean, Bonnie mentioned Bell versus Anthem. There were a number of cases over the course of the last 2 years which talked about money market returns. And frankly, some of that was talked about prior to, almost all of it was talked about prior to what I think is some of the most material changes in money market regulations really since the advent of the money market. So coming out of the financial crisis, liquidity crisis of 2007, 2008, we've had some pretty material changes. We had the break of the buck for one of the oldest money market funds in the country. And the breaking of the buck was a byproduct of the fact that that particular investment manager held lots of commercial paper associated with entities that were either potentially in bankruptcy or were bankrupt at the time. And obviously for defined contribution plans, which have used money markets for some time, as the preservation of capital vehicle, that had a material impact, and the Securities and Exchange Commission stepped in to change the regulatory environment. So unlike the fiduciary rule that Bonnie's going to talk about, which is scheduled for implementation in 2017, the money market changes are already now complete. So the changes were primarily to increase the quality of assets, decrease the duration of assets, making them more liquid to put less pressure on money market funds in the event of a financial crisis, which from a quality perspective is all, obviously good news, right? Better investments, higher grade debt, less duration, so less exposure to risk over the long run. The problem is that there's always a risk-return trade-off. So when you reduce the amount of risk, even in a money market fund that you can take, the certain outcome of that is a reduction in return. And what we're expecting to find in 2017 is some pretty material changes there. So when the Securities and Exchange Commission came out with their regulations, they really had two steps to it. In April, they made some changes that helped categorize products between governmental funds and prime funds, the primary difference being that prime funds would be subject to potential liquidity constraints that would make them, in many cases, difficult to use in a defined contribution plan. And as a result, we've seen movement away and into government money funds where liquidity is certain. In April, they started doing some stress testing on funds to make sure that they'd be prepared for the change. And by October of 2016, all money market funds had to declare either that they were a prime fund or that they were a government money fund, and where they could be used in accordance with the new SEC regulations. The impact on retirement plans, again, is going to be likely a reduction in returns. Some of that may be offset by the increase in interest rates I mentioned earlier. We've been in such a low interest rate environment for such a long period of time, which has led to at least some of the claims that have been made in these class action suits. The increase in debt quality in money market should decrease returns. Hopefully, some of that will be offset by the increase in rate environment that we've seen over the course of even the last 2 months. As a result, though, of the Bell Anthem cases and the changes to money market returns, plan sponsors are going through a process, or should be going through a process, of reviewing their cash equivalent alternatives to determine whether money markets still are appropriate given their objectives. And there's no finite or definitive answer to that question. Defendants who have been pursued for having money markets as investment options have been successful in having those claims voided by being able to demonstrate that they evaluated other alternatives and chose money market for the security and liquidity that comes within that space. But having those discussions will be a critical part of any fiduciary's defense strategy, and again, could be highlighted further by the changes that just took place in October. The next we wanted to talk about, or fourth on our list, was really the change to the revenue model in defined contribution service environment. And this has been a slow-moving process that certainly has hit a tipping point, I would argue, over the course of the last year. So for decades, defined contribution 401k plans and 403b plans used a very arcane process of having revenue-sharing dollars from investment products in many cases, not all, but in many, even most cases, compensate record keepers and administrators for providing the record-keeping, administration, and employee communication services to their clients. What that ultimately led to was products of varying expenses, some portion of that expense attributable to the cost of investment management, but other aspects of it paying for other unrelated services to the investment process. It made it, A, difficult for plan sponsors to understand plan economics. B, made it virtually impossible for plan participants who had less transparency into the economics to understand the impact of their investment decisions on fee payment processes. And a number of changes have driven us to this tipping point. Certainly the delineation of revenue sharing on Schedule C of the Form 5500 was one step in that process. Certainly the 408b2 disclosures from plan providers to plan sponsors has helped create more transparency. And add to that, the disclosures through 404a5 by plan sponsors to plan participants has been impactful. And add to that, the litigation that Bonnie mentioned earlier, combined with a tremendous amount of media attention related to the process, has changed the environment dramatically. And what we're finding is a significant proliferation of investment managers launching investment products with zero revenue sharing, meaning that the only cost for the investment product is related to investment management exclusively. So no revenue sharing payments to third-party providers, to brokers on the outside, or any other provider. So a participant is getting the least expensive version of that particular product. In cases where revenue sharing still exists, we're seeing things like fee equalization, where revenue sharing amounts can be reduced or increased to match the economic need of the plan. We're seeing a tremendous move, especially among larger plan sponsors, away from asset-based pricing models to per capita or per person pricing structures to try and cap the amount of compensation that service providers are earning. And as a result, we're seeing vendors react. I think the two primary things we're seeing is certainly a tremendous increase in the number of transaction fees or project-based fees that are being charged by providers. And last but not least is among many providers, there is a significant focus now on cross-sell opportunities, whether it's managed accounts, whether it's target date funds, proprietary target date funds as part of the process, or other related services on the retail side. Record keepers are trying to find other ways to augment revenue in what has been a narrowing margin marketplace over the course of really the last 10 years in the retirement services marketplace. I'll hand it back to Bonnie to talk about the DOL fiduciary rule.
Great. So I think our fifth and final observation as to major things that happened in 2016 was the Department of Labor's fiduciary rule. And I don't want to belabor what the rule actually is because we've done a couple of webinars over the past year about the substance of the rule. But in short, DOL, or Department of Labor, created a rule which became effective last summer, and the applicability date is this coming April 10th, 2017. So in other words, that's when everyone would start having to comply with the rule. And the rule seeks to expand the definition of advice so that more financial professionals will become a fiduciary, or rather have a higher standard of care when working with retirement plans and retirement plan assets, including IRAs. And that IRA piece is really the big piece that was really new. So to achieve this, the rule did several things, but basically to boil down over 1,000 pages into 3 bullet points, it did, it revised the definition of fiduciary under ERISA. It created some activities that were excluded from that definition. So one of them being what you probably have heard a lot about, is education, which is carved out or excluded from advice. And then there were a series of prohibited transaction exemption revisions, and then one of those, which is this inclusion of the best interest contract exemption. And so some of you are probably starting to see a little bit around the best interest contract exemption. If you're a plan sponsor, you may be in receipt of some materials from your vendors. So, since the rule came out, the Department of Labor has issued some additional guidance. So, for example, last fall, there was some guidance provided to financial professionals in the form of FAQs. And then just here, right before the changing of the guard, and right before Perez left his post, we received an additional set of FAQs to financial professionals. And then additionally, there was another set of FAQs that was issued, and that was actually meant for investors or plans. And so that gave some clarification for example, for plan sponsors or investors, so that they could read those FAQs and basically understand, hey, if I don't want to read this 1,000-page rule, I can read these, I think it was about 35 pages, and understand the rule. And then it also had one page right at the end that had a set of questions that an investor or a plan sponsor could use to ask their advisor some questions to find out, hey, is my advisor doing what's right by me, essentially. And so that was what came out right before we had the change on the 20th of this month. So, the real question is, will this rule stick? Because, it had big impacts for investors and plans, and particularly financial professionals. And so, there's a lot circling right now as to, will the rule stick? Will the rule get pushed back? President Trump's order last Friday for a regulatory freeze doesn't pertain to an investment advice regulation that was issued under Obama's administration. And we won't go into the weeds as to how that works. But, to boil it down, there are ways that the rule can get pushed back or gutted, essentially. And I think, I've put on the slide a few ways that can happen by essentially there's a lot of different cases that are pending where industry groups, for example, have fought the rule. And so one way would be that you essentially stop fighting back on those cases. I think that's highly unlikely, but that's possible. There could also be congressional action because this basically became kind of a partisan issue. So given now the majority in Congress, there could be some congressional action there. Again, I think that's not as likely. I think some of the more likely outcomes is that, for example, the Department of Labor may propose to delay the rule. So, for example, if we have that confirmation hearing on the 2nd with the new nominee, then the Department of Labor could propose a rule delay. But however, that would need to go through a public notice period, just like the rule initially went through a notice and comment period. That same process would need to happen. Or the Trump administration could issue an order to delay the fiduciary rule. That, again, apparently would need to have a comment period. However, the Trump administration, if they could show good cause, for example, substantial harm to these financial institutions, that could be the good cause that would say, hey, we don't need to have that notice and comment period. So I think most likely the rule will have some sort of delay. However, there's no delay yet, so until then, everyone has to keep preparing for the rule accordingly. So I think the most likely outcome is that we'll still see some sort of rule, and I'll talk a little bit more about this in a minute when we get to kind of the 2017 outcomes, but we'll still see some rule, just likely with some sort of delay. So with that, I think I'll go ahead and pass it to Erik so that we can really get into what 2017 likely looks like for plan sponsors and what committees should be doing accordingly.
Thanks, Bonnie. As a matter of course, I don't frequently get into the market prognostication business because I think it's a difficult place to operate on. But in talking to clients over 2017, I think it is notable that the likelihood for continued market volatility, and volatility is not always bad. So I would argue that what we've experienced really since November 9th is volatility. It's just been high side volatility. The problem with volatility is that, some of it's going to be high side, some of it's going to be low side. From an expectations perspective, certainly we're looking forward saying, if the economy is strengthening and finally bond yields are increasing, that's going to have a negative impact on bond investors. And bond investors are not just those, obviously, who are nearing or in retirement, although that's a material portion of the population. It certainly has an impact on target date mandates, which have become increasingly popular. I think that volatility may also show up on the domestic equity side. So the first wave of market volatility seems to be a reaction to the potential likelihood of the new president to get some of his economic agenda in place. I think the next wave is likely to be a review of what individual companies may be winners and losers in that marketplace. So financial services companies we've talked about. The second wave potentially is healthcare companies and insurers, depending on what the ACA, if the path is to repeal and replace, clearly repeal and replace will have a material impact on healthcare companies as well as insurers within that market space. And depending on what the replacement looks like and how the repeal goes, that could either be high side volatility or low side volatility. But I think we're going to continue to see that on the domestic equity marketplace. And then last but not least is, as these trade deals become more and more impactful, the U.S. economy, if it continues to be strong or strengthening, increases the value of the dollar. This whole notion of currency will become pretty important. I mentioned in my earlier remarks the trade deficit for the third quarter. If the trade deficit is then combined with material changes to trade policy, that could have either positive or negative impacts on exporters that I think will show up in market performance as well. So from a retirement committee perspective, certainly examine your investment policy statement. We've done a number of webinars on this particular topic. One of the most risky things you can have in an investment policy statement from my perspective and our firm's perspective is some kind of policy that says if A happens, then B must happen, especially in an environment where volatility is high. Those types of dictatorial policy documents may put you in a place where your policy tells you to do something that may not be in the best interest of the plan from a fiduciary and participant perspective. So addressing those issues now before you're addressing them because they've occurred, clearly is wise. The second piece is really to focus on employee communication. There is as there is with most elections, a tremendous amount of anxiety among the marketplace. So getting participants to focus on long-term rather than short-term performance and volatility, I think, is certainly critical. Again, in the near term, the short-term volatility has been high side. As that balances itself out over time, as things typically do, you clearly don't want to have participants making decisions that in the long run will hurt their retirement preparedness.
Great. So another one of the kind of outcomes, and again, I'm like Erik, I generally, excuse me, I generally don't try to project things, but I think, unfortunately it will be highly likely that litigation will continue into 2017. I don't think it's going anywhere, and unfortunately, as we have maybe some deregulation or less regulation, I think that unfortunately litigation will step in and kind of fill that gap to an extent. So as we see continued litigation and increased litigation, I think, just really sticking to adhering to your fiduciary best practices is really what we would recommend. And, there's really some great evidence out there that by sticking to those fiduciary best practices, you can really have some success in litigation. So, for example, there is a case out of California that we did a blog post on earlier this year, which is the Chevron case, and it really demonstrates that you can get some of these big cases against Schlichter out of St. Louis, which is the big plaintiff's firm. You can get those dismissed when you have your fiduciary file in order. So, doing things like meeting quarterly and documenting via your meeting minutes, reviewing the plan's governing documents and updating those as necessary, things like your investment policy that Erik was just talking about, things like utilization of a committee charter, and then, of course, making sure that you're actually operating in line with those documents that you have in your file. Also making sure that on an ongoing basis you understand the fees that the plan is incurring and then monitoring those fees and, of course, documenting that exercise. And of course, then reviewing and monitoring investment options on an ongoing basis and documenting that exercise. You keep hearing the word document, document, document. But really, it's just sticking to those fiduciary best practices that we talk about over and over. I think if you do that, you shouldn't be fearful of litigation. You just stick to those best practices, and then you'll be prepared if that would ever arise.
And moving back to the money market issue and documentation, as Bonnie just mentioned, I think that given the new regulatory environment for money markets, even with a bump in the long intermediate term rate, that doesn't necessarily correspond to a material change in short term or especially ultra short term rates. So as part of your documentation process, I think it's really critical to look at your language on cash equivalents, both your language in your investment policy, but also your language in minutes related to the review of those particular investment products. The number of committees that actually don't monitor performance of their money market because they don't find it material is surprising, especially given the fact that in most plans, the cash equivalent is going to hold somewhere between 8 and as much as 25% of total assets. So having minutes that demonstrate that you've looked, whether you're using money market or whether you've elected to use stable value, whether you've elected to use a combination of both, having that discussion at the committee level, having that memorialized in minutes as well as your policy statements is going to be critical to being prepared for, again, what could be very easily another decade of returns that are less than the inflation rate. The accelerating rate of class action suits on fees and fee reasonableness is clearly an area where both litigators, as Bonnie mentioned, as well as DOL regulators have been focused. Again, whether this administration chooses to continue that focus will be an interesting subplot, but the auditors who are in the marketplace are asking tremendous number of questions related to fees. As we look at committees, we always put together a stepped approach, right? The first is we have to evaluate our current service providers and covered service providers under the new regulations to ensure fee reasonableness at a total plan level. The second piece of that is to review how those costs are being allocated. And I really believe that this second issue is the one that is the next wave of attention. While the Department of Labor has continually asserted in very soft language that revenue sharing is acceptable in the marketplace, looking at how revenue sharing is used, how it's allocated, and how costs and expense are being allocated, and is that being communicated to participants is an area of potential risk. So making sure that the committee is aware not only of the total reasonableness of fees, but how those fees are allocated, and do they feel comfortable that that is a fair and reasonable process for allocation. And then repeat that process regularly, because we continue to see compression in the fee marketplace among investment providers, record keepers, and others in the space. The greatest area for easy pursuit from a class action litigator is when you're using more expensive alternatives of the exact same investment product. So in cases where you are doing that, being able to document the why is going to be very, very important. And if there is no good why, then looking at those alternatives to reduce plan investment costs is going to be critical.
Perfect. And last but not least, finishing up with the Department of Labor rule and where we see that headed in 2017. I think there is certainly a lot of uncertainty around this rule and what happens next. But I think the one thing that's fair to say is that financial services firms have spent the last 2 years essentially gearing up since they initially saw the proposed rule come out in April of 2015, and they've spent substantial amounts of time, money, marketing efforts around preparing for this rule. And that particularly applies, for example, to your vendors or record-keeping partners that you're working with. And so I think at this point, even if the rule were pulled back entirely, I think it would be very difficult for a lot of your record-keeping partners, for example, to totally unwind that approach. So, a lot of the record keepers that we meet with regularly to see how they're working with our plan sponsor clients, we've been asking them, how will you proceed even under the new administration, even if the rule doesn't go ahead? And a lot of those vendors are saying, we're still continuing down that same path, just given that all of the policies and procedures, agreements, and everything have already been put in place, and all of the marketing efforts that have been put around that as well. So I think it's fair to say that even if the rule doesn't go forward on the same timeline as initially proposed, or with the same maybe teeth as initially proposed with some of the best interest contract provisions, I think that some form of the rule will go ahead and continue to go forward. It just may be in some of the nuances around it. But as far as what I would consider next steps for a retirement plan committee, I think it's critical to continue to reach out to your service providers to understand how they're handling the Department of Labor's fiduciary rule, regardless of whether it goes forward or not on the 10th of April. I think it's critical to ask if those record-keeping partners, if they're meeting one-on-one with your participants, if they'll be doing so as a fiduciary or not, or if they'll be doing so in more of an education capacity. I would also continue to ask those vendors or record-keeper partners if they will be providing any disclosures or documentation that you'll need to sign off on prior to the 10th of April. Because to date, the rule is still going forward. Also, at this point, because the rule is still going forward, plan sponsors would still have a requirement to be monitoring any education materials made available by vendors to ensure that they're objective and not biased after April 2017. So until notified otherwise, I would continue to plan to be able to be prepared to do that. So with that being said, I think that really wraps up kind of our overview of 2016 and outlook for 2017. And I'll go ahead and kind of pass it back to Erik for any questions and concluding remarks.
Thanks, Bonnie. So I'm going to give people a little bit of time to enter some questions that may have come up over the course of the presentation today. So I'll let folks type those out. We had one that came during the middle of the presentation related actually, Bonnie, to this last topic in the new fiduciary rule. So the questioner asks, I received a fiduciary form from my provider asking me to assert that I was a sophisticated investor with assets more than $50 million. Are there any risks in executing that document?
Sure, I think that's a great question. So I think at this point, most of the disclosures that we've reviewed from those record-keeping partners with respect to the sophisticated fiduciary disclosure, those have not been, a revision to the actual record-keeping agreement. Rather, they're really just an acknowledgement form. So provided that it's simply an acknowledgement form, I don't see any risk because you're simply acknowledging, yes, I have X amount in assets, or the alternative that we've seen also is that, yes, I'm working with an advisor, and my advisor is, for example, Multnomah Group, and you're just signing off, and it's really just an information request. So I wouldn't see that there's any harm in going ahead and signing that acknowledgement, returning it back to that record-keeping partner at this point because it's simply an acknowledgement. And a lot of the vendors, as I mentioned, are still preparing for the rule because at this point, the rule is still set to go forward on April 10th.
Great, thank you. Going to give it one more minute here for slow typers, if there are any, to submit any additional questions. And then, as always, want to thank everyone for attending today. Hopefully, there is some good activity that you can take into what, at this point, is still a relatively uncertain 2017. Although, I suspect that if I look back at our 2015 to 16 and 14 to 15 and 13 to 14 reviews, that like frequently is the case, plan sponsors do face a tremendous amount of uncertainty when we can't predict exactly what regulatory environment looks like and exactly how the courts will react to the plaintiff's bar, as Bonnie mentioned earlier. So with that, I think I'm going to close it out for today. Again, thanks so much. We will be sending out a copy of the materials, and in the next 2 to 3 days, we should have a recorded version of today's presentation as well. Hope you all have a great day. And again, thank you so much for participating.